Welcome everybody to the Ellsworth Advisors monthly update. Today is Monday, May 6th. It's actually about 8:45 in the morning, and I wanted to introduce my associate Cameron Miele. I'm Kelly Kuennen, and today we're going to share with you really what's transpired through the month of April, whether it's in the markets, economic activity, and then a quick review of how our various portfolios have performed throughout the month, what we see coming down the pipe, why things kind of played out how they did. So today we'll start off with a little economic update from Cameron, and then we'll get into how the portfolios and markets performed, and kind of cover any other hot topics that have been playing out over the last couple of weeks. And really this morning, a lot of news right out of the gate. There's some trade tensions with China. So looks like we're going to go into a little bit of rough period with the market. So I'm going to kick it off with Cameron. Tell us a little bit about the economic update.
Thank you, Kelly. Yes, I was planning on spending my segment talking about the glowing U.S. economy. Then all of a sudden, Friday, President Trump tweeted out his displeasure with the Chinese and the continued trade disruption, and that really has put a damper on the markets. China was down 5% today. Looks like the U.S. futures were going to open up about 460 points down in the Dow. So the big headline news is going to be China. But if you look beyond trade, the U.S. economy continues to look very strong. So last week, we got first quarter GDP numbers in. First quarter GDP grew at an annualized rate of 3.2%. That was easily beat the expectation of 2% and 2.2% from the fourth quarter. So GDP growth, very strong, historically strong. In April, the U.S. added 263,000 jobs versus an estimate of 180,000. Unemployment, again, remains near a historic low of 3.6%. Inflation came in so far in the first quarter at 1.9%. Very manageable. One of the things we've talked about, we've been concerned about, is wage inflation. However, in the first quarter, we saw significant increases in productivity, meaning that the cost to manufacture a widget is taking less labor dollar inputs versus in 2018. So with that strong growth in productivity, we can continue to see wages increase without really causing any inflationary pressure. Fed's fund rate remains at 2.5%. Last week, the Fed decided not to raise interest rates, given no indication that they want to raise interest rates. The president's called for actually a cutting of interest rates, but we don't see that happening. So, by and large, the U.S. economy, really over what we've seen over the last 20 years, is really humming at a great level. Things that can throw off the economy, there's some global tension. Again, China, unfortunately, we're watching before our eyes a sovereign nation in Venezuela disintegrate. There is U.S. tension with Iran. There's Palestinian-Israeli tension. And then we continue to see a slowdown in Europe and Asia. So within the U.S., within our kind of four walls, the economy remains extremely strong. We've got some global pressure points. This China thing is obviously going to upset the market. The stock market is not the economy, but it is a good reflection of people's expectations. So we are going to see some volatility. But as far as the U.S. economy goes, we want to be cautious, but things still look very strong.
Thanks, Cam. Welcome to May. Mm-hmm. 'Tis the season for Middle East tensions. After a tough winter, they got to get some things fired up here for the spring. So going into the summer, April once again was a good month. Cameron talked about the better than expected economic numbers, which going into the quarter, everybody was expecting maybe 1%, even negative GDP growth. The talk around earnings was, hey, earnings are going to be terrible. Companies basically set the bar pretty low, and we get through earnings season, which we're pretty much, the majority of S&P companies have reported and have beaten their earnings estimates. Earnings growth is slower than what it was last year, but that's really no surprise. And a lot of times when you're in earnings season, it's all about, exceeding expectations, and expectations were set pretty low. I think they're keeping the bar fairly low for next quarter, but we'll deal with that in a couple months once we get into second quarter earnings season.
Well, I think there's also a psychological effect here, where we've been in this decade-long bull market. Everybody keeps saying it has to stop, it has to stop, it has to stop, and there's not really any signs that it's stopping. But our mindset is so set that things can only be good for so long. So I think that there's a lot of psychology that's playing into this market right now.
I agree, and the diversification of the U.S. economy is pretty great, where you're seeing some sectors are performing well, other sectors are not. Big picture, we're still seeing growth in the economy. That's really the bottom line. We're definitely in a different economic landscape with the way the Fed is controlling the money situation, but we're also in a situation where the U.S. is continuing to chug along, but we still have weakness in Europe, which is definitely, puts a drag on the U.S. economy. China's gone through their rough patches, and especially in the interest rate world. Cam talked about where the Fed is keeping interest rates. The reality is, if rates weren't so low in Japan and China, in Europe and Japan, our rates would probably be a lot higher now. But it's really the low interest rates in Europe and Japan that are holding our interest rates down. So the Fed really can't get too aggressive without pushing us into a recession, which, at some point, we assume there's still a business cycle. It seems like we haven't seen much of a business cycle for 10 years, just small ups and downs. Hey, we have to play with play the cards we're dealt. And so far this year, things have been playing out fairly well for us. We do realize we're towards the end of an economic cycle. The market's been pretty rich. We've had a great rebound, so we can't get too aggressive. But then again, we really believe we need to keep our feet in the pool to participate in some upside. So getting down to the markets themselves, in April, the S&P 500 up 3.93%, Dow Jones up 2.56%. The developed world internet, the EAFE, I didn't have the exact April numbers, up about 1%. Emerging markets have lagged, up only about 2.8%. I think part of that is the dollar remains strong. And once again, that's because we're the healthiest nation. That's definitely keeping our currency as kind of the highest peg. And also with us having the highest interest rates for our sovereign bonds, that tends to attract a lot of dollars from around the world. In Germany, you're getting negative interest rates for 10 years. Japan, you're getting negative interest rates for 10 years. US, you're getting 2.5%. Obviously, money's going to flow there. That's going to keep our dollar up. And strong dollar puts a little bit of pain, or not pain, but definitely restricts emerging market growth. So that's kind of what we're seeing in the world in the indexes. Year to date, S&P up 17.5%. Dow's up 14%. The developed world, 13%. Emerging markets up 12%. So pure numbers year to date, we're off to a great start. Will it continue? I think by the end of the year, we'll probably see higher numbers. Between now and then, we're probably going to see some lower numbers.
Little chop.
Maybe we see some chop this week, or at least that's what it looks like coming out of the gates. Now, when we look at our portfolios, growth with income portfolio, which is really more of a balanced portfolio, I think we have 55% equity exposure right now. Month of April, up 3.1%. Great month for growth with income. We've actually seen commodities. Commodities year to date are up about 11.2%, which it's been a long time where I could report commodities being up double digits. So this early in the year. So that's maybe reflecting some inflationary pressures in the in commodity type goods. One unique thing, even though
oil's at a
Yeah, oil, definitely energy pushing that up. So that's commodities being pushed by oil. Gold, though, gold is flat year to date. So it's not inflation being caused by rising gold because of people panicking. We'll see how gold reacts today with the short-term news this morning. I would guess
pretty sure I know which way it's going.
I guess we might see a little bit of bump in gold. If not, that means this is purely going to be a headline-driven type risk. And in the grand scheme of things, I think what we're seeing, especially on the trade talks, is really headline-driven. We've seen this move before. God forbid get in the mind of Trump, but he's a negotiator. He sees a lot of good news coming from the U.S. the first 4 months of the year. Economic numbers are good. When's a better time to put some pressure on China?
Absolutely.
China's struggling a little bit. Yeah, he's going to hit some pain points. Okay, let's press the trade issues a little bit. I don't think anything's breaking down from a trade talk standpoint. This is just a course of negotiations.
I still think we get something done, and I think that what people fail to realize is for years we've been talking about we need China, we need China, we need China. They manufacture everything. And as it turns out, as we've seen, China needs us.
Oh, absolutely. Yeah,
we are the world's largest consumer, and I think they might have gotten a little ahead of themselves in thinking that they have the power in the relationship, but they really do need the U.S.
I agree 100%. This weekend was the big shareholder meetings in Omaha for Berkshire Hathaway. So driving in, listening to CNBC, they have Charlie Munger and Warren Buffett talking with them. And obviously the trade situation came up. And I think, Warren Buffett hit it right on the head. You have, the two probably leaders in the world from an economic standpoint, geopolitical standpoint. That's what's going to be moving forward. It's always going to be some tension between the U.S. and China, but the reality of it is they need us as much as we need them. It's definitely a symbiotic relationship, but there's always going to be tensions because the way they perceive the world and the way we perceive the world is different. We both have our self-interest, but once again, everybody's better off working together. And we're in a big negotiation, which we haven't seen these strong of negotiations with China for years and years and years. It was always kind of do whatever keeps things as smooth as possible. But ultimately, that has to change, and we're going through that change right now.
That was a very politically correct way of saying we've always been the wimps in the relationship. Let the Chinese devalue their currency and push us around, right?
But we needed that because you need a stable China, bottom line. So growth of income, once again, had a great month, up 3.1%. Part of that driven by two of our stocks had a solid month. Disney up 23%. We've held Disney for a long time. We've made money in there, not tons of money. It's kind of like finally Disney pops. It's always been held down a little bit because of the whole ESPN situation where ESPN wasn't the behemoth that once was. Disney bought ESPN 20 years ago, so their numbers have always kind of stagnated, plateaued. Disney has built the rest of really their movie business that is now really driving the company, and that was really realized last month with a nice 23% pop. Another company that had a real good month was Microchip Technologies, up 20%. Once again, a long-time hold of ours. Microchip's been good for us in the past and busted out a nice solid month for us. So that really helped propel that portfolio to a strong month. Year to date up 11.8%. Going to the beginning of the year, would I think growth of income be this strong? Absolutely not. But it's playing out pretty well. So, and I like the positioning. Like I say, we're not overweight stocks. We have good, solid treasury positions in there. We have some gold. We have some commodities, kind of balance things off. Just a nice, simple way to attack what we see moving forward. Our other portfolios, price potential, all 20 more growth-oriented stocks, up 2.53%. Kind of a mediocre earnings season. No big winners, no big losers. Nothing, up or down more than 5%. Just kind of mediocre. We've done some repositioning in there. Year to date, up about 12%. So we're lagging, but I'm going to remain patient. Stick with our strategy and price potential. Once again, we're staying away from some of the higher price stocks or higher value stocks. So if it's high valuations driving things, we're going to lag, which we're seeing a little bit of resurgence there. Dividend yield, our conservative dividend play portfolio, up just under 2%, 1.9% for the month. Not too bad. Year to date, up 12.7%. Once again, no big winners or losers. Boeing's been a little bit of a drag on that portfolio, but the reality is Boeing's still positive for the month, or still positive for the year, even through all their issues they had with the 737 MAX. And that's the news on that starting to die down a little bit. Small caps through the month, up just under 2% again, about 1.9%. Small caps, always very volatile. Year to date, up 13.98%. So they're definitely participating to the upside. Small caps, always going to be a little bit more volatile. A couple days last week, we saw some big movers in there, plus or minus 10%. I don't list all those because the nature of that portfolio is a lot of volatility. I could be talking about a lot of stocks which come and go. That's just the nature of that portfolio. So in general, I like how we're positioned. In my note I wrote last week, I think everybody received probably over the weekend, the expectation is for a little bit of volatility. Market's been hot, went through a decent earnings season. Things are going to be a little bit quiet on the earnings economics front, but hey, great time for unrest in the Middle East, fire up some China talks, and all of a sudden we get some volatility, which is coming at us today. How long it lasts, it's hard to say. I don't see tons of downside in the short term. Are we due for a 5% pullback, even 10%? I don't think it's out of the cards, but for how much we've moved, we have to expect some pullback here. Will it happen this month? Possibly, but I think in general, the stage is set for decent economic conditions. I don't think we've seen all the upside year to date. I mean, we just exceeded the all-time highs on the S&P. Was that last week?
Last week.
Yeah, last week. So we surpassed what we saw back in September. I'm forgetting, it's been so long now. The highs in September, we revisit those highs. We'll break through. We'll see some new highs as we go into the year. The question is going to be, are people going to still, we don't see exuberance yet in the market. Right. And you need exuberance for a top. I saw it written last week. You have FOMO, fear of missing out. That's will probably drive exuberance, but you also have another camp out there, which is the fear of losing money. Still a fairly strong camp. As long as we have two good groups on both sides, I think we keep on advancing in general. As the fear of losing money crowd migrates over to the fear of missing out crowd, that's when we could see some exuberance. It definitely could happen this year. You get a good trade results. Market keeps on moving.
I mean, if U.S. and
people
China
start running up, and then
if the U.S. and China actually
dicey.
make a trade accord where the U.S. can regain billions of dollars that we're losing out on, yeah, you're going to see. I would think you're going to see a big pop in the market.
You're going to see a market run, and people are going to start jumping in,
Yep.
and that's what I'm going to get really, really nervous. And once again, we start revisiting our allocations like we did at the beginning of the year, and you know what? Start pulling the horns a little bit.
Well, and I think it's important for our our clients, to remember is that as your wealth manager, we're not chasing returns. We're trying to build a high quality book, utilizing multiple portfolios. I always have people say, okay, the S&P 500 was up 17% year to date. What are you guys up? That's not what we're here to do. We would never put anybody, even our youngest of clients, we're not going to put somebody in a 100% stock-based portfolio. That would be irresponsible. So as we've always talked about, we're not chasing returns. We buy high-quality companies, so we do really well when the market's up. We pull back less when the market's down, and we recover quicker when the market rebounds. So that's what we're really trying to do, and that's why we have balanced portfolios.
You said it well. Basically, we want to align your money with what you're trying to achieve. Every client is different. What they're trying to achieve is different. We have different time frames, different risk tolerances, build around that. And everybody's returns are going to be a little bit different, but based on, hey, what do we see coming down the pipe? Protect against what could happen, but also be there to participate in the upside so that we can, once again, we're trying to outpace inflation and help clients maintain their lifestyle. That's really the biggest message.
Absolutely.
That's what people really want. A return number really doesn't mean a whole lot unless it's in the context of your situation. So that's really where we're at. May, once again, could be a dicey month. Back in the day, it was sell in May and go away. We really don't buy into that. Historically, between May and October, the market experiences its lowest returns, but lowest average returns doesn't mean negative returns. It just means the other part of the year you tend to have higher returns, and that all falls into kind of the financial cycle, the tax cycle, and the weather cycle. Back in the day, in the middle of summer, you don't want to be on the unair-conditioned stock exchange, or so there wasn't a whole lot going on in the summer, so you had the lowest performance.
Yeah, you have to remember, people are traveling, people are vacationing this summer. Europe, they're taking a couple of months off, so volumes are always down in the summertime.
And it's a natural thing, but we're going to stay invested unless something major happens. And hey, if the landscape's changed and we are pulling the horns, I don't see that happening until we get this final leg up, which could come this year, could not. But when we don't think recession's happening, the way things are playing out, that'll probably be a early next presidency type scenario if it's going to happen, which is typical.
And just remember, even though everybody else is out on the golf course, Kelly and I are in the office every day working hard for our clients.
You know how to reach us. We appreciate you joining us on this call. And we're wrapping up for the month of May. We'll talk to you early June. And once again, reach out if you have any questions or concerns. Thank you.
Thanks, everybody.